What's good everybody and welcome to today's brand new video where today we're talking about ICT's number one favorite strategy to use. He said this in multiple videos before, private and on YouTube, that this is his favorite strategy, and if he had to trade one model for the rest of his life, this is what it would be. Now, to kick things off, this is based around market maker models, okay? The main thing he said he would trade if he could only trade one thing for the rest of his life is a market maker model. Now, there's a specific stage in this market maker model which he said he would actually choose, okay? So I'm going to tell you right now that this is pretty advanced. This strategy is an advanced strategy, but I can simplify it down for you. Okay, so the market maker model is basically something that looks like this. Okay, we have a consolidation, a leg higher, accumulation, a leg higher, more accumulation, and then a final leg higher for a smart money reversal. Now, a smart money reversal trades into a higher time frame PD array or a higher time frame liquidity pool. We then go down, get a leg lower, have a low risk sell, break lower, have a first distribution, break lower, and then have a second level of distribution. Now, the second level of distribution is what I have heard ICT trade many times and say is his very favorite setup. This is the one setup if he could trade anything, and he says when he used to run up accounts back in the day on Twitter, on YouTube, whatever, this is the model he was using. This is the setup that he was taking to run up these accounts. When we get to this second level of redistribution, which clears out the original consolidation. So if we move this away from here, you can see this becomes our market maker sell model. Okay. So the depictions are a lot clearer than this. As you see, consolidation, level up, entry, level up, entry, and then so on, so forth. What we want to focus on is this side of the curve, okay? So once all this forms and we trade into a higher time frame PD array here, okay? Let's say this yellow level, or we'll make it a bit more visible. Let's say this blue level is a higher time frame PD array, okay? Now we're in bearish momentum, so we've been trading lower all through here, then we get a pullback. We get a pullback, and it shows in a consolidation, a level of accumulation, another level of accumulation, and then we trade into that higher time frame PD array. This is when we start looking for that setup, okay? We break lower, we have a low risk sell, which despite its name is, I think, the highest risk entry in this model. We then break lower again and have a first level of distribution. We then break lower again and have a second level of distribution. Now this right here, what we will highlight here, is exactly what Michael likes to trade. He likes to trade this because it is the quickest leg of distribution on this side of the curve, which usually clears out the original consolidation here. Now, it does this because all on this side, banks and institutions are accumulating orders, okay? They're accumulating longs here, accumulating more longs here, and then here again. So on this side of the curve, what we like to see is where they accumulated longs, we like to see it line up with where they accumulate new shorts or where they distribute their new shorts, okay? So I'll make this a gray color so you can see. This would be where they previously bought into this PD array. We then trade below it. Once we trade below it, we want to line this up with new PD arrays on this side. Okay, so let's say our second level of distribution forms inside an old area of buying. Now it could be this area or it could be this area here. As long as it forms inside an old area of buying, this is where we now look to sell short. So I will dive into some examples here. Just a quick one before we get started here. If you guys are looking to get funded, I'd highly recommend Funding Engineer. I've traded with them many times before and I found them to be the most trustworthy company to work with. They have 4 leading industry challenges here as we speak, and if you do want to support me, please do click the link in my bio and my description to sign up so I can continue giving away to you guys. You will also be entered into a bi-weekly giveaway when you sign up through that link. So that being said, we'll head back to the video. You can see we have the original consolidation at this point, okay? Accumulation, reaccumulation, and then smart money reversal into a higher time frame PD array. What's the PD array? You see this was a very sensitive level. We have a fair value gap in there, and I'm sure on the weekly we have another fair value gap. So the part we want to be focusing on here is the second level of distribution. If I could trade anything, if I only could trade one thing for the rest of my life, this is exactly what I would trade as well. We wait for the smart money reversal to happen, which is here. We then wait for the low risk sell to happen, and we watch this. You don't have to trade this. Now remember, this is a daily chart, so obviously if you were trading the market maker model on this time frame, you would be waiting a long time. But these happen on the 1 hour, on the 4 hour, on the 15 minute, 5, 1 minute. They happen on every single time frame because price is fractal. So as these are happening on the daily time frame, all of these candles in here are little market maker sell models. Okay, so you can be trading intraday all of these. Just for this example, I'm going to show you this level. So we let the low risk sell happen, we let the distribution happen. You can see this is it. Why? Because we broke a low here. Okay, we trade below this low, which came up to make the low risk sell. We then trade below it and then get a tap into this order block. Now we've had what? The smart money reversal into the PD array, the low risk sell, the distribution. So there's 4 stages on this side. We then wait for the 4th and final stage. Now what do? We break a low inside here. And then you can see, are there any significant PD arrays here? You can see this fair value gap then gets used for the second level of distribution. Okay, so you would take a sell there, stop loss above there, and run out the liquidity below here. Okay, so sometimes we use the 50% mark of the original consolidation as a target, and then other times you can use the lows. If we're significantly bearish, it will run below it and clear out the lows. The point here being, if you look on the buy side of the curve as well, this is the buy side of the curve, this is the sell side of the curve. Previously, institutions sold in this area, okay? Bought in this area, sorry. These 3 down close candles were used for buying, okay? Any down close candles on this side of the curve are used as selling opportunities on this side of the curve. So when these 3 candles here, which we'll make blue, are used, does this, once traded through here, traded below, does this line up with any PD array here? And you can see it lines up perfectly with the fair value gap, which would be used on our second level of distribution down below the lows. And you can see as soon as we do that, look how many down close days we have. Open, high, low, close, open, high, low, close, open, high, low, close, and so on and so forth, down towards the consolidation. And this happens all the time. You can see we started a buy model here, smart money reversal, low risk buy, accumulation, more accumulation, and then it pumps up. Look how quickly it moves from here. Look how quickly it goes up into a what? Up into a premium array. If we take our premium and discount, you can see we're in a deep discount, trading higher, and then trading into a premium fair value gap. Okay, and now if you were to go short, you would look smart money reversal, low risk sell. If we break lower now, then you would start to get, remember, the first distribution here, and then the second level of distribution. And remember to line it up with this side of the curve. Down close candles on this side of the curve used on the other side of the curve. So in simplicity, I want to keep this video short and sweet. The aim of this is to just get it in your head so you can go into your own charts and backtest this. Look at this strategy. When does it form? How does it form? And why does it form? Why being the key part? What's the narrative behind each time this forms? If you get that down on a notepad or on your computer, whatever, in some form of notes, then you can look for this in the future. You know what parameters this forms under and what parameters it doesn't form under. So I hope you did enjoy that video. If you did, please do drop a like and a comment. If you're new, please do subscribe. And as always, thank you for watching. I will see you in the next one.